Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines. Today, um, we're diving deep into some potentially turbulent waters. Think choppy markets, political undercurrents, and even a few corporate dramas unfolding. Ready to navigate this with me?
Absolutely. Let's chart a course through these headlines and see what we can uncover.
Okay, first up, let's set sail for the Eurozone. The Bloomberg article, EU economy. Eurozone private sector fails to grow for second month. Doesn't exactly paint a rosy picture. What's the headline here?
Well, the Eurozone's private sector has stalled out, failing to grow for the second month in a row. That's based on the Purchasing Managers Index, which is kind of a big deal when it comes to gauging economic health.
Okay, but the Eurozone feels pretty far away. Why should this matter to, say, someone listening in California?
It's all interconnected, right? A sluggish Eurozone can ripple outwards. For example, a weaker euro could actually make U.S. exports less competitive, which could end up impacting companies you're invested in even if they're based right here in the States.
So what's driving this slowdown in the Eurozone? Is it just one thing? Or is it more complicated than that?
It's a mix of factors, but Germany's economic woes are a big part of the story. Think high energy costs stemming from the ongoing geopolitical situation. And then you've got weakening demand from China, which is dealing with its own economic slowdown. It's hitting Germany hard. And since they're a powerhouse of the Eurozone, everyone feels it.
And Bloomberg really drives home the human side of this, too. They point out that employment has been falling for 3 straight months in the Eurozone. That's a lot of people feeling the impact of this slowdown.
Exactly. It's not just abstract numbers. This translates to real job losses across the continent.
Okay, let's shift gears from the Eurozone and zoom in on an American company that's facing some serious turbulence. Boeing. The Wall Street Journal has a piece titled, "Boeing's Strike is Still On. Its Strained Balance Sheet Makes Matters Worse." What's the latest with this corporate giant?
Boeing is dealing with a perfect storm right now. You've got the workers' strike, which is costing them $1 billion a month, according to the Wall Street Journal. Add to that a mountain of debt they're carrying. And you've got a recipe for a potential credit downgrade to junk status. That's a pretty steep fall from grace for a company like Boeing.
Whoa, that's intense. And the Wall Street Journal even hints that the U.S. government might need to step in to prevent a full-blown bankruptcy. It's crazy to think that a company as big as Boeing could be in such a precarious position.
It just shows that even giants can stumble. But it's a complex situation. On the one hand, you've got these massive financial challenges, but on the other hand, Boeing still has this enormous backlog of orders worth billions of dollars. It's not a simple case of a company on the verge of collapse.
So there's a glimmer of hope there amidst all the storm clouds. Let's switch gears again and head back to the U.S. to check the pulse of our own markets. Bloomberg's got an interesting article titled, "Era of Big Price Hikes is Over, Giving Comfort to the Fed." What's the takeaway here?
Well, it seems like the era of pandemic-era price hikes is fading. Businesses are finding it tougher to raise prices, and consumers are becoming much more selective with their spending, pushing back against those inflated costs.
That makes sense. People are feeling the pinch and they're not willing to just accept price increases anymore.
Right. And this shift is actually giving the Federal Reserve a bit of breathing room. They're in this tricky balancing act, trying to stimulate the economy by cutting interest rates, while also keeping a close eye on inflation.
So if businesses are finding it harder to raise prices, that should help ease inflationary pressures, giving the Fed more leeway to cut rates further without sending inflation spiraling, right?
That's the logic, and there's evidence to support it. The Fed's Beige Book, which, by the way, is a report that gathers anecdotal information from businesses across the country, indicates a growing trend of consumers being more price sensitive. They're trading down to less expensive alternative, forcing companies to adjust.
Bloomberg even gives us a real-world example of this. They highlight a retailer in Maryland called Hobbyworks that's actually stocking up on more affordable items to meet the changing demands of their customers. It's like the shoppers are dictating the terms now, not the companies.
That's a great point. It really highlights the power shift that's happening in the marketplace right now.
Okay, now let's add a layer of geopolitical intrigue to the mix. Bloomberg has a piece titled, "China Plays Nice with U.S. Partners Ahead of Possible Trump Return." What's going on here?
Well, it seems like China is actively trying to improve relations with key U.S. allies like India, the UK, and Australia.
Those are some pretty significant players on the global stage. Why the sudden charm offensive from China? What's the motivation?
Some analysts believe it's a strategic move by China to hedge against potential economic turbulence if Trump wins the upcoming U.S. presidential election.
So they're basically trying to build strong relationships now, just in case things get rocky with the U.S. later.
Exactly. It's like they're laying the groundwork for a potential economic buffer.
And if we connect this to what we were talking about earlier, a Trump victory could reignite those trade wars and lead to higher tariffs, impacting both domestic and international markets.
It's a reminder that politics and economics are deeply intertwined, especially on a global scale. What happens in the U.S. doesn't stay in the U.S.
Okay, now here's a connection I wasn't expecting. MarketWatch has an article titled, "Here's the Biggest Threat to the Bull Market," according to one strategist. And it suggests that the performance of U.S. tech stocks, especially those in the AI sector, is surprisingly tied to the value of the Japanese yen. How does that even work?
It might seem like a stretch, but the connection is real. Japan's real interest rates are deeply negative right now, which has incentivized investors to borrow yen and invest in U.S. tech stocks, essentially looking for higher returns. It's created this interesting dynamic where the fortunes of U.S. tech companies are, to some extent, riding on the value of the yen.
So if Japanese interest rates start to rise, or if investor enthusiasm for AI cools down, we could see a sell-off in tech stocks, potentially impacting the entire market.
Exactly, and that could lead to a surge in the value of the yen. It's a delicate situation that's worth keeping an eye on.
Definitely something to watch.
Yeah.
Okay, before we wrap up this part of our deep dive, let's do a quick rundown of some notable earnings reports from the week. Bloomberg has all the details, and it looks like we've got a mixed bag of performances.
First up, Tesla. They delivered a blowout quarter, exceeding earnings expectations and offering a really upbeat outlook for 2025. No surprise, their shares soared after that news.
That's impressive, especially considering all the headlines swirling around their CEO Elon Musk and his potential role in a second Trump administration, which, by the way, was also mentioned in that Bloomberg article.
Indeed. It seems like Musk thrives on being in the spotlight, no matter the context. Now, let's jump over to the world of memory chips. SK Hynix, the South Korean chip maker, is reporting record profits, all thanks to the booming demand for memory chips used in AI applications.
So while some sectors are struggling, the AI boom seems to be lifting certain companies to new heights.
Absolutely, but not everyone is riding the AI wave. Boeing, unfortunately, continues to struggle. Their workers just rejected a proposed pay deal, prolonging that strike that's really hitting their operations hard. Both the Wall Street Journal and MarketWatch have the details on this, and it doesn't look good for Boeing.
That's a major setback for them, and it's only going to further impact their already shaky financial standing.
Now let's shift to the pharmaceutical industry. Bloomberg has an interesting article titled Sanofi. Bankers do anything it takes to grab a piece of rare French buyout, which details how French pharmaceutical giant Sanofi is selling a stake in its consumer health arm.
And apparently, banks are practically lining up to underwrite this deal. It's like a feeding frenzy.
It's a rare opportunity for them to get in on a large-scale buyout in the current market environment, so they're eager to grab a piece of the action.
Finally, let's end on a high note with a company making waves in the autonomous driving space. Bloomberg reports that Horizon Robotics, a Chinese company, just had a hugely successful initial public offering in Hong Kong, making their founder a billionaire overnight.
It's a testament to the growing investor interest in the future of autonomous driving.
It definitely seems like a sector that's attracting a lot of attention and investment.
Well, we've covered a lot of ground here, from economic slowdowns and corporate struggles to political maneuvering and the ever-evolving tech landscape. It's enough to make your head spin.
It really highlights how interconnected the global financial system is. One event in one part of the world can trigger a cascade of reactions across markets and industries.
And we're only just getting started. We'll be back after a quick break to delve even deeper into these headlines. Don't go anywhere.
It's fascinating how one seemingly isolated event can create a domino effect across the global financial landscape.
Absolutely. Speaking of global connections, one of the articles that really caught my eye was from the Wall Street Journal. Their piece titled, "Gold Prices Expected to Continue Rising in 2025." suggests that gold is about to get even more valuable. That's right. And it's driven by a combination of factors. Geopolitical tension always makes people nervous, and gold is seen as a safe haven asset. Add in the strong demand from China and the expectation that the Federal Reserve will continue to cut interest rates, and you've got a perfect recipe for a gold price surge.
So even with all the market volatility we've been seeing, gold still holds its allure as a safe haven.
It absolutely does. And as investors grapple with uncertainty surrounding the U.S. election and ongoing conflicts around the world, the demand for gold is likely to persist.
Speaking of staying informed, we also talked about the surprising influence of Japan on U.S. tech stocks. The yen's impact, as highlighted in that MarketWatch article, is something that many investors might not even be aware of.
It's a crucial connection, and as that article pointed out, it could have significant implications for the future performance of the tech sector.
Now, let's turn our attention to Brazil. They've got a big interest rate decision coming up, and things are getting interesting. Yahoo Finance has an article titled Tight U.S. Election Cloud Scenario for Brazil's Next Interest Rate Decision. And it highlights the unique challenges facing Brazil's central bank as they prepare for their November rate-setting meeting.
It seems like they have more to worry about than just local inflation. The tight U.S. election is injecting a whole new level of uncertainty into their decision-making process.
It's like they're trying to hit a moving target. With the U.S. election falling just one day before their meeting, Brazilian policymakers are essentially going in blind.
That's a great way to put it. They have no way of knowing what the U.S. political landscape will look like when they make their decision.
And the possibility of a Trump victory is already impacting Brazil's financial markets. Their currency, the real, has weakened significantly against the U.S. dollar, raising concerns about imported inflation.
That weakening currency makes everything they import from other countries more expensive, which can fuel inflation within Brazil.
So how are they dealing with all of this?
Well, some analysts believe the central bank might have to resort to a more aggressive interest rate hike to counter these external pressures. We're talking potentially as much as 75 basis points.
Wow, that's a bold move. It really shows how interconnected global politics and economics are. One election in one country can create ripple effects across the globe.
It's a reminder that we live in a complex and dynamic world where events can unfold quickly and unpredictably.
So given all the information we've covered today, the Eurozone slowdown, Boeing's troubles, the Fed's balancing act, China's strategic moves, Japan's influence on tech stocks, the looming U.S. election, and even Brazil's rate decision, what stands out to you as the biggest takeaway for our listeners?
I think the overarching theme here is interconnectedness. Whether we're talking about political risks, economic trends, or corporate performance, everything is intertwined. What might seem like an isolated event in one corner of the world can have far-reaching consequences.
That's a powerful insight, and it really underscores the importance of staying informed about developments in seemingly distant corners of the world.
Absolutely. What happens in one market or industry can have unexpected consequences elsewhere. We can't afford to have tunnel vision when it comes to investing and understanding the global economy.
So as we navigate this complex and dynamic landscape, what advice would you offer to our listeners? What can they do to stay ahead of the curve?
I think the key is to remain adaptable and open to new information. Don't be afraid to challenge your assumptions, and be willing to adjust your investment strategies based on the evolving global picture.
That's sound advice. Flexibility and awareness are essential tools for navigating today's turbulent waters. It's not enough to just react to events as they unfold. We need to anticipate and adapt.
I couldn't agree more. The more we understand the forces shaping the financial world, the better equipped we'll be to make informed decisions.
And that's why we do this deep dive each day, to help our listeners connect the dots and see the bigger picture.
Exactly. It's about empowering people with knowledge so they can navigate these complexities with confidence.
Well, we've certainly covered a lot of ground today. Given all these factors at play, where do you see the greatest opportunities and risks in the market right now?
That's the million-dollar question, isn't it? The current market environment is like a giant puzzle with pieces constantly shifting. But that's also what makes it so fascinating. Opportunities can emerge in the most unexpected places, just as risks can lurk around seemingly safe corners.
So what's the one thing you want our listeners to walk away with today? What's the key message you want to leave them with?
Stay curious. Stay informed, and don't be afraid to ask questions. The more you understand the forces shaping the financial world, the better equipped you'll be to navigate the ups and downs of the market.
It sounds like we're in for a truly wild ride. Buckle up, everyone. But before we go, I have to ask you, after this whirlwind tour of global finance, what's the one thing you think our listeners should really be paying attention to? What's the signal amidst all this noise?
Honestly, it's about recognizing the patterns. We've talked about slowing growth in the Eurozone, corporate struggles like Boeing's, the Fed's delicate balancing act with interest rates, China's strategic maneuvering on the global stage, even the unexpected link between Japan and U.S. tech stocks. It all points to one crucial insight: volatility.
So you're saying we should be prepared for more unexpected twists and turns.
Precisely. The days of steady, predictable market growth might be behind us, at least for now. This interconnectedness we've been discussing means shocks can come from anywhere, and they can spread quickly.
Sounds a bit unnerving, but is there a silver lining here?
Absolutely. Volatility creates opportunities. For investors who are informed, adaptable, and perhaps a bit daring, this kind of market environment can be incredibly rewarding. It's about recognizing the potential in those unexpected shifts.
So instead of fearing the volatility, we should learn to embrace it.
Exactly. It's about shifting our mindset from one of risk aversion to one of opportunity recognition. Of course, that doesn't mean throwing caution to the wind. It's more about staying informed, doing your research, and being prepared to adjust your strategies as needed.
Sounds like a solid approach.
Hmm.
So if our listeners could only walk away with one piece of advice from today's deep dive, what would it be?
Don't get caught off guard. Stay informed, stay flexible, and keep your eyes on the horizon. There are incredible opportunities out there for those who are willing to ride the waves of change.
Wise words. Thanks for joining us today and for helping us navigate these turbulent waters.
It's always a pleasure to dive into these headlines with you.
And to our listeners, thanks for tuning into the Pro Ticker Podcast. We'll see you all tomorrow morning with new headlines from major financial magazines.